Okay, well, good afternoon, everyone, and welcome to today's session with great friends of BGL Corporate Solutions, ASF Audits. We are thrilled to be joined by Shelley Banton, who's very well respected and admired for her fantastic knowledge and what she brings to the industry. And I can confidently say, looking at the slides, that you're in for a treat today. And what Shelley's going to be talking about is the evolution of cryptocurrency. And in going through the slides and having a look at the content, I'm really pleased to be able to tell you that what has been put together will go a long way in helping you not only better understand cryptocurrency, but then also how to prepare for the audit. So as part of today's presentation, we're going to be going through, or Shelley's going to be going through the different cryptocurrency types. She's going to be looking at things like some of the fails and the scams and some of the things that are out there that you need to be aware of. We're going to talk a little bit about storage, hot wallets, cold wallets, and really importantly, we're going to talk about how to prepare a fund for audit, which includes cryptocurrency. Now, during the session, feel free to ask questions. I'll be looking at the Q&As that do come through. I will ask Shelley those questions during the presentation if the time is right. If not, we'll hang back at the end of the presentation and we'll go through the Q&As with you. So Shelley, thank you for joining us. It's always a pleasure being alongside you, and I'm really looking forward to what you have to present today. Thank you.
Thanks, Daniel, and thanks to BGL for the opportunity to present today. I know that there was a presentation yesterday on cryptocurrency, and I'm sorry if I'm going to be going through anything that you already covered off, but I'm very excited to be here as we start delving into the Pandora's box of digital assets. So the interest we are seeing in cryptocurrency is happening obviously for a variety of reasons, and not least of which is our low interest rate environment, which means that SMSF trustees are going to continue looking for assets that's going to provide them with a return that's much greater than the cash rate of 0.1%, and also will be accepting a greater level of risk into the bargain. Now, since the first Bitcoin block was first minted back in 2009, thousands of cryptos have emerged with varying degrees of success, but Bitcoin continues to remain the most popular. We're seeing major companies such as Microsoft starting to accept Bitcoin. And when you combine that with the ease of setting up a digital wallet and the low returns that we've just spoken about, trustees are looking at crypto as a more attractive yet riskier investment. The problem is that many SMSF trustees simply don't understand how it works. And that means that funds are investing in volatile, high-risk investments that have no underlying assets or government regulation to support the price. So from that point of view, are they sitting on an investment time bomb? Now, the ATO has said that crypto is neither money nor foreign currency, and any comparison between cryptocurrencies and the dollar, the euro, or a pound is simply not relevant. We know that while crypto is an allowable asset under SIS, it can generate compliance issues and it comes with risks. So I guess the purpose of the presentation, as Dan said, is to demystify crypto and hopefully give you the tools to ensure that the fund's investment in crypto meets regulatory compliance and, most importantly, get you through the audit. So let's get started. Okay, but first, my disclaimer. What we're going to be talking about today is not financial advice, and it should be used for compliance purposes only. So as always, I recommend that you absorb everything, be a sponge, squeeze out what you don't need, and then just use what you want. And if all else fails, please seek professional advice. So what is crypto? It's basically a digital currency which uses encryption techniques to generate coins and tokens and to also verify the transfer of those funds. It is a virtual currency which is essentially operating as online cash, and the ultimate aim of it is to reinvent the way that money works. So it operates through a decentralized peer-to-peer payments network, which relies on public key cryptography to validate those transactions. And it lives in electronic ledgers that are continuously updated, open to everybody who uses it, and anyone can also download it. And if that sounds a little bit familiar, it is, because I've just described the blockchain in very simple terms, of course. Now, the value of crypto isn't derived from gold or currencies, but it's simply based on demand and supply. And as they don't generally earn income, their only return comes from when they're sold at a higher than original price. And there are other factors which also influence the price, such as how easy is it to trade or use that crypto, the perceived value of the currency, and it also includes the blockchain technology which underpins it as well. So we need to also remember that anybody can create a crypto asset. So if Shellcoin wasn't taken, I could actually create Shellcoin today. And Bitcoin is just one of the 4,000, more than 4,000 cryptos currently available, which is quite phenomenal when you consider that there was only 66 cryptos in existence back in 2013. Whoops. I thought this would be a really interesting graph to show you because it proves that the dominance of Bitcoin is still there over an 8-year period in terms of market capitalization. You can see that Ethereum is a very distant second, and the times where the price of Bitcoin peaks, that shows a close correlation in the demand for other crypto as well. But the focus obviously continues to be on Bitcoin as investors continue to pour into the market, and SMSFs are starting to account for a large portion of that as well. Crypto exchanges have reported significant growth in their portfolios from self-managed super funds, with the largest crypto exchange, BTC Markets. They reported a 5-fold increase in SMSF customers in 2020, and also an increase in their average trade size of 20% over the final quarter of 2020 as well. Independent Reserve, which is another Australian crypto exchange, said that their new accounts have climbed 150% in January this year versus December last year, and they now have over 9,000 SMSF clients. So I guess things like fear of missing out, chasing greater returns, and follow the lead is some of the things which is driving this new SMSF investment class. Now this morning, one Bitcoin was worth 44,000 Australian dollars, and early this year it peaked at 85,400 odd dollars. Now there's many reasons that accounts for this, not least of which is the Elon Musk factor, where in February Tesla said that it had owned $1.5 billion worth of Bitcoin on its balance sheet. And it was looking to let consumers use Bitcoin to buy their cars and SUVs. Then in May, it did a reverse and pulled out of that deal, saying that they were concerned about the increasing use of fossil fuels for Bitcoin mining. And as we know, China has recently kicked out Bitcoin miners by literally pulling the plug on their operations. And those miners are currently in the process of relocating their operations to other countries such as Kazakhstan. So when we see firms like Microsoft, as we've said, PayPal, Bank of New York Mellon, and BlackRock starting to use Bitcoin and accept it, that's also helped validating it. Investors are also seeing this as a good hedge against inflation and a weaker dollar, especially if the bond yields start to rise again. And earlier this year, we saw the US 10-year bond rate soar by 50 basis points, and Australia closely followed that lead. Now, obviously, there's been a slight correction since then, but the markets have started to factor in increases in interest rates happening sooner rather than later in Australia, New Zealand, and the US. And the Reserve Bank, of course, may have other ideas about that, but they still haven't ruled out an interest rate rise before 2024. I should also mention that the Elon Musk factor has sparked surges in the price of other types of crypto. And the most notable one is Dogecoin, which was a digital coin that was originally started as a joke back in 2013. So in February, he tweeted that he bought some Doge for his son, and which saw a 16% increase in the price. And it's not the first time he's done it. And just a few days ago, he tweeted, "Release the Doge," alongside a meme showing Marlon Brando as the Godfather, because Elon is the Doge father. And the price of Doge jumped by 4%, which just goes to show once again that there's no intrinsic value in crypto. Okay, let's have a look at the types of crypto that are available. We're only going to be able to go through a few today, but the bigger ones, as we said, is Bitcoin continues to be the most popular. And its users in the Bitcoin network, which are the miners, and the way this is how Bitcoin is generated, they use these computer-intensive software to validate the transactions that pass through the network, and they earn new Bitcoin in that process. So while Bitcoin uses a decentralized global payment system for some payments, it's also largely bought and sold as a speculative investment. Ethereum, on the other hand, operates on an open source platform which uses blockchain technology, and it processes smart contracts, and miners verify those to earn Ether, which is a crypto token and can also pay for fees and services within that particular network. Litecoin is an electronic payment system which processes transactions much faster than Bitcoin. Interestingly, there's a lot more Litecoins in circulation than there are Bitcoins, and the process is also said to be a lot greener than Bitcoin in terms of the energies used to validate those transactions. Ripple is designed to complement Bitcoin, and that allows real-time transfers between users in any currency, including other cryptos as well. And it actually is a database in real terms where users store and transfer their value in any currency. And from that point of view, it's a bit of a protected network which uses tokens created by the developers rather than them being mined or earned like other digital currencies. Now, some users don't see Ripple as a real crypto, but the technology has been very popular with financial institutions. Lastly, stablecoin, also known as Tether, is a marketing term for crypto that's supposedly less volatile than standard cryptocurrency. And it tries to stabilize its market by attaching itself to a government currency, such as the US dollar. And it needs to maintain a supply of dollars equal to the supply of stablecoins to keep that pegging system in place. And it also uses algorithms to control the supply of available tokens. Let's just have a quick look at cryptocurrency exchanges, because there's a lot of different websites where you can buy, sell, or exchange crypto for either digital or traditional currency. Now, to do this, you obviously need to open an account where you verify your ID, but there's also a lot of platforms that exist that allows you to make the occasional trades, and those that you can that don't have to require you to have an account. So the types of crypto exchanges available to use are trading platforms, which just simply connect buyers and sellers and take a fee from each transaction. Direct marketing platforms, which offer obviously direct trading, but they don't have a fixed market price, but instead each seller sets their own exchange rate on that platform. And the last one is brokers, which are just websites that anyone can visit to buy and sell crypto at prices set by the broker. So I guess in this sense, crypto brokers are similar to FX brokers at the end of the day. What we see here is that there's roughly 370 platforms that you can trade on, and there's 337 centralized exchanges, which are simply those platforms where you buy and sell crypto using that third party to conduct the transactions. And these are the trading platforms and brokers that we've just spoken about. Now, the buyer and seller here has to trust the exchange to hold their assets. And they also have to trust them to securely store their crypto and also complete the transaction. The largest exchanges here are Binance, Coinbase Pro, and OKX across the world. And last year, Binance was accused of money laundering, which is also another reason why crypto is so popular. Now, Dr. Craig Wright, who is also an Australian and claims he's Satoshi Nakamoto, who was the founder of Bitcoin, claims that Binance may be responsible for laundering up to $2.1 billion a year in criminal proceeds. And just recently, we saw the UK ban Binance from operating in that country, which adds to Canada and Japan, who have also not allowing Binance to operate in those countries either. With a centralized exchange, you don't actually own the crypto until you withdraw it from the exchange to your personal wallet. And 13 of these exchanges also offer derivatives trading on crypto, which allows investors to simply take a hedge or take out a futures contract or open a margin lending account. And once again, the three largest ones are Binance, OKX, and BitMEX in that area. There are also 39 decentralized exchanges, and these are called DEXs, that are direct trading platforms which basically cut out the middleman, and they allow investors to buy and sell crypto directly with each other on an anonymous basis. So in a DEX, the investor controls their funds at all times, and they can trade coins and tokens in that peer-to-peer setting. The good thing about it is that there's less risk of hacking and server downtime if you use a DEX. The fees are minimal compared to a centralized exchange, and they also provide more privacy. But it's not all wine and roses. there are epic crypto fails whereby millions and billions of dollars are lost each year. Now, the most noticed one collapse that we've seen is the Dow, which raised over 34 million in 2016 through a crowdfunding exercise. And investors initially purchased the Dow by the truckload until hackers got in and siphoned a whole bunch off, about a third of it, and then traders dumped the Dow by the truckload. And what we're going to see is we're going to see these types of cybersecurity incidences continue that is going to affect crypto. ASIC in particular has seen an increase in the number of scams, which has been an increase in the report of misconduct over January and February this year, which is up by 200% overall compared to last year, which is pretty significant numbers. Most of these are just outright scams, but the offenders are very difficult to catch because they're operating outside of Australia and all contact is online as well. So the way a typical scam works is investors being called with an investment opportunity. They sign up, they start onto a crypto asset trading online account, and they deposit funds into that account either through a crypto wallet or a bank account. And of course, the platform's fake, but it looks real, and then they're encouraged to deposit more funds. So when an investor initially logs into their account, it looks like they're making a lot of profits, which is fake data, obviously, but eventually shows trading losses, even though there's no trading that's been undertaken. And when the consumer wants to withdraw their funds, the Bitcoin scammers either cease all contact or demand further payment before their funds are released, which obviously it never really is. And one of the things that they're looking at in terms of this, the scammers is also to mine personal information to engage in identity fraud as well. So it's another thing they're looking to undertake. In April this year, we saw AfriCrypt, which was a South African crypto investment firm set up by two brothers in 2019, and it was worth an estimated $3.6 billion. They shut down their platform and told their clients that they had been hacked. Now, the brothers sent an email to their clients and said not to report the hack to law enforcement because it would slow down the recovery process. But what the brothers did the week before they sent this email out, they sold up all the assets, they transferred funds from bank accounts and client wallets, and then put them through tumblers and mixers over the internet to make the funds untraceable. Then they disappeared. So the scam process was similar to what we've just spoken about because the investors put money into AfriCrypt, saw healthy returns on their dashboards, and then borrowed more money to invest. Ponzi scheme is also investment that we're seeing. We have seen traditionally with crypto where we see payment of returns go into existing investors from contributions from new investors. And the biggest Ponzi scheme we saw then in crypto was in OneCoin, which emerged from a Bulgarian-based company back in 2014. So there was no products or memberships that were being peddled here, but there was just a cryptocurrency that the promoters were looking at and telling everybody was going to be the next Bitcoin. Those who were familiar with crypto exposed this as a pyramid scheme way back in 2015, and a lot of institutions and governments were quick to issue warnings. But nonetheless, the company became very popular throughout the world, and the US government alleges that their scheme brought in about $4 billion worldwide. Now, the outcome for the promoters in this particular case has been extremely dire because 2 of the 3 promoters have been found murdered in Mexico back in June 2020, and the other's still on the run. Who knows how that's going to end. But in March this year, ASIC alerted investors about a suspicious investment opportunity that was in Australia called the BGL Corporation. And this was a similar scheme that had been trading overseas with those unrealistically high and guaranteed returns. They deposited crypto with Burex, and then they were unable to withdraw their investments. And obviously ASIC was concerned because it's going to be difficult to trace any of those crypto payments. There's no protection, and ASIC has no way of helping recovering those funds, and the likelihood of recovering those investors' money was also extremely low. Okay, so obviously, where crypto has started to come into SMSFs, the ATO has shown interest. Back in 2014, they issued 2 tax determinations, TDD 2014/25 and 26, which clarified that Bitcoin and cryptocurrencies like Bitcoin are not money but are CGT assets. So where a fund does transact in crypto, trustees need to be aware of the tax consequences as well as price volatility, because that's going to impact their returns. So if SMSF is involved in acquiring or disposing crypto, must keep perfect records concerning their transactions, because it could give rise to a CGT event. Now, in general, crypto is classified as a personal use asset if it is kept or used mainly to purchase items for personal use or consumption. So an example of a personal use item is where a person acquires crypto and uses it to pay for tickets or computer games or other goods and services. So obviously this is outside the scope of what SMSFs are allowed to do, so they traditionally acquire the crypto for investment purposes. So the investment risks of trading in crypto are mainly related to that price volatility. It is also high risk and speculative, as we know, because there's a lot of quick changes to market sentiments which affects the price. It's also an unregulated market, so there's a lot of questions about the susceptibility of error here, and also hacking with little possibility of preventing any of those technical glitches or human error that may in fact occur. Crypto can also be affected by forks or discontinuation, and that sees investors switching to a new chain and no longer using the old one. Or there's situations where both the new and the old chains are maintained and compete for dominance and branding. So examples of that is where we see Ethereum versus Ethereum Classic and Bitcoin versus Bitcoin Cash. We need to be aware that there's a significant difference between an ICO and an IPO. Now, there are new cryptos being promoted and sold through ICOs, initial coin offerings, every single day. It is a raising of capital by offering new crypto to the market, but what it doesn't do, it doesn't offer a share in the company or into the crypto company itself. Now, during 2019, ICOs raised about $14.8 billion through over 4,000 ICOs. And on any given day, there were an average of 482 ICOs opened, and each one raised about $115 million. And here's the worst bit, only 33% of all ICOs were completed over that year. So under their capital raising banner, they're selling tokens to investors. These promoters are selling tokens to investors who are paying with legal tender or other cryptos such as Bitcoin or Ethereum. Now, as we've said, they're not the same as IPOs because they're not regulated. They don't give a share in the company, and they're prone to scams and also security laws violations as well. Now, the most common scam we see is that pump and dump scam. So the scammer talks up the value of an ICO to generate the interest and then dumps the coins for profits. And obviously we get very concerned at audit when we see a deposit paid out of the fund for a new crypto that's been sitting on the balance sheet for maybe the last 2 years. And we'll ask what's going on with that ICO, and inevitably we're told there's been a delay or it will happen within the next 12 months. And this is where our auditor spidey senses go into overdrive, because that well may be the case, or else it may well be the case, and there's a 33% chance that it's the case that a trustee may have been scammed and effectively lost their money. Okay, let's talk about the practicalities of storing crypto. So investors buy or sell crypto on an exchange platform, as we know, using traditional money, and the crypto then needs to be stored into a wallet, which is basically a software program that enables investors to store, send, and also receive digital currencies. Now, each crypto has a different address, and some wallets can hold multiple cryptos, which may, and some don't. So depending on what cryptos you're holding, you may in fact have to set up numerous wallets, especially if the crypto doesn't support the crypto that you're buying. Now, the wallet contains a public and a private key. Now, the public key is a long sequence of letters and numbers that forms the wallet address, and that's similar to a bank account. The private key, on the other hand, allows the investor to access the funds stored in the wallet, and that's similar to a PIN number, which needs to be kept secret and secure. An exchange can provide a wallet for storage, but it means that the exchange stores that private key on behalf of the user. Now, the main thing here to note is that an exchange wallet is a custodial account which is provided by that exchange. Now, while that might be convenient, It can also compromise security, because where the exchange stores millions of private keys, they then become targets for motivated and well-resourced hackers. And one of the most well-known hacking incidents occurred in January 2018, where CoinCheck, which was a Japanese-based crypto exchange, had their servers compromised, and hackers stole about $500 million worth of investors' digital coins. Okay, what about hot wallets? Well, these are online wallets, and they run on the internet through computers, phones, or tablets. The security surrounding a hot wallet can be a little bit vulnerable, because their wallets actually generate those private keys on those particular devices. Now, the types of wallets here show a list of what crypto they hold. So, for example, if you selected an Exodus wallet, you could store a number of cryptos there, but if you bought or sold an Electrum or a Mycelium wallet, you could only store Bitcoin or BitX on those particular wallets. Okay. A cold wallet, on the other hand, is not connected to the internet. So that where that definition comes from, it's not connected to the internet, and it stands a much less risk of being compromised. They're also referred to as offline or hardware wallets as well. Now, the types of wallets that are used are USB drives, specifically designed to store physical crypto and the user's private key more securely than what it would do in a hot wallet. One of the drawbacks of a cold wallet is that transferring crypto can be a little bit more difficult and less practical. And it can be a security risk, obviously, because if you lose them or you forget that security code and the passwords, you're not going to be able to trade your crypto.
Shelley, just a real quick question that's come through from Jamie. Can I buy crypto via an exchange with an SMSF and then store offline, personal ledger X, or does it have to be stored on the exchange?
No, it doesn't have to be stored on the exchange. You actually have, and obviously it depends on the rules of the exchange that you're dealing with. But in most cases, you're able to take that that crypto off the exchange and store it in your hot or cold wallet.
And just one other thing, are you happy for your slides to be made available at the end of the presentation?
Yep, but they are subject to copyright. So
Fine.
Not a problem, yeah.
Okay, thank you.
Okay, thanks. All right, so just going through, having a look at what the cold wallets are available to buy. The Ledger NanoX is obviously the most popular one that's available in the market today. Okay, let's look at classification of cryptocurrency, because as a digital asset, auditors start getting very wary about how it's classified on the fund's financial statements. Because it's a very volatile asset, an incorrect classification may actually result in issues, not only for the trustees, but also for auditors down the track. And the reason for this is that we've seen crypto incorrectly classified as cash. And I guess one of the reasons is the use of the word currency in the term cryptocurrency doesn't help us. But we've also seen cryptocurrency incorrectly classified as foreign currency, foreign assets, unlisted units, unlisted unit trusts, and listed shares. So the problem with this is that trustees can have their investment decision-making impaired because they think they have less volatile assets than what the fund actually does. So we need to take extra care at audit to ensure that the correct classification of crypto is in the balance sheet. And we would expect to see this as either digital assets, other assets / cryptocurrency, or just as cryptocurrency. Are we overreacting? Well, the problem of misclassification was one of the cornerstones of the Camembert versus McGoldrick auditor case that we saw the last couple of years. And in that particular case, the New South Wales Court of Appeal found that the auditor engaged in negligent, misleading, and deceptive conduct. And the issue at stake here was that the auditor was signing off on the fund's financials and failing to qualify the audit report because the trustees had invested in high-risk unsecured loans to unrelated private companies, which were reported simply as cash. So the court determined that the auditor, Mr. McGoldrick, should have made proper inquiries of that financial condition of that company, which would have alerted him to the risks associated with that investment, which he then could have communicated to the trustee. So the case obviously shows that auditors are now being held to a higher standard by the courts, and this is regardless of whether the trustees have financial sophistication and or awareness about their investments and incur losses or not. Because in this case, the auditor didn't alert the trustees to the risks involved where there was a misclassification, but was still held accountable for the losses in the fund at the end of the day. And that's just one of the reasons why we're going to review crypto very carefully. So let's have a look at SMSF compliance in relation to crypto. And we'll start off with the sole purpose test. So given that the original purpose of crypto isn't for trading, is it an appropriate investment for a fund, and should it pass the sole purpose test? Well, of course, the fund trustees can invest in any assets allowed under SIS as long as it's a permitted acquirable asset. And the investment must pass what I call the rule of three. First off, it's got to be allowed for under the fund's trust deed. It must be in accordance with the investment strategy, and it must comply with the SIS requirements concerning investment restrictions. So let's talk about trust deeds for a second. Some trust deeds often have a prudent trustee investment consideration depending what state or territory act relates to that particular trust deed. So trustees need to consider those crypto investments and review the trust deed to see if those particular provisions exist. And in some circumstances, it may actually be difficult to comply with these provisions in the trust deed and invest in crypto due to the high risk nature of that asset. Trustees are also bound by the governing rules of the fund relating to investments. So trustees need to ensure that the governing laws expressly allow them to invest in crypto or not explicitly excluded. And in most times, we just see that generic clause in the trust deed which says that the trustee can invest in any other asset allowable under SIS. In relation to the investment strategy, obviously the trustee is required to formulate, review regularly and give effect to an investment strategy under Reg 4.09. Now, the investment strategy should and must allow for investment in digital assets. The reason is that crypto, as we know, as we've already said, is a high risk investment due to volatility of prices. And there's no income generated from crypto, and the return is coming from that speculative capital growth. So the investment strategy does need to mention these risks concerning the investment in that particular asset class, along with other risks concerning the secure storage of the hot or cold wallet and the private keys. Now, SMSF auditors don't want to know about where all of that's stored. We just want to make sure that it's actually been checked off as a risk profile within the investment strategy, and that there is some sort of plan in place which will pass that information on in the event of something happening to the trustee or untimely death. We also got to consider risk management provisions here, because under SIS, if a person suffers loss or damage from investing in an asset class which isn't covered by the trust deed or the investment strategy, as we saw in those two auditor cases, a trustee can take action against a person involved in the contravention to recover the amount of the loss or the damage. So here, by way of example, where an advisor assists a client in investing in cryptocurrency and the governing rules don't authorise it, they may face legal liability if the member suffers loss or damage, and the auditor will also be in that firing line too, where they don't pick up that particular issue and communicate that to the trustees.
Shelley, just a couple of questions that have come through. One from Jerry, which is for crypto stored on cold wallets, how do we provide for audit purposes that it belongs to an SMSF, i.e. separation of assets requirement?
Yeah, it is a little bit more difficult, but at the end of the day, if we can get a screenshot of the wallet, we can see the money that's come out of the fund to pay for it. There may be an invoice for that wallet. They're the sorts of things that we're looking for. And this is where it gets a little bit trickier with crypto, because we don't always have the answers, but we have a series of evidence which will point us in the right direction and allow us to tick the box in terms of fund compliance with Reg 409A.
And would an audit, this is a question from David, would an auditor require access to the wallet holding the cryptocurrency to verify the investment?
We're going to be going through this in great detail, but we do require at least information from the wallet, such as the wallet ID address and the transactions that have happened during that year, so that we can track those.
And how do auditors confirm, this is from Johnson, how do auditors confirm if the fund's cryptocurrency has been stolen, scammed or hacked?
Well, what we're trying to do is reconcile the amount that's been paid for from the bank account with the crypto, what transactions have happened through the year. And at the end of the day, it's a very good question, because the reports that we're getting from the exchange and obviously the reports from the wallet are unaudited reports. And we'll be getting into this very soon. You'll find that a lot of SMSF auditors will qualify Part A because we simply cannot confirm that there is any material misstatement in the financial statements. So it's a good question, and we'll get into that in just a short while.
There's just a couple more that we'll close off. It's like, if the trustee member did some Bitcoin mining and put the mined Bitcoin into the SF's wallets, as an auditor, what's your view on how to treat this? Do we add the asset with no cost base, i.e. the trustee mined the capacity of the trustee, or a contribution, the member mined and put it into the SF? This is from Grace.
Well, unless the super fund itself is having a business and they're mining Bitcoin themselves as a business, which is highly unlikely, and you can't, you wouldn't be able to mine it personally and then contribute it into the fund, because it's you can't acquire that asset from a related party, which is basically what you're doing. And we're going to be going into that in just a short while as well.
And one last one from Chris, Shelley, and we spoke about this before.
Yeah.
As crypto trades 24/7, 365, what's the easiest way to confirm the valuation at 30 June? I think you're going to touch on this a little bit later on.
Yeah, look, there's several websites that you can go to. We have one, and I'll be mentioning that in a short while. But basically, it just needs to pass the reasonable test and the materiality test. So if we're doing a reconciliation of what's the value of the crypto at 30th of June from the website that we're looking at, and then it's obviously at a different price in the balance sheet, we'll then have to look at whether that difference is clearly trivial or not. If it is clearly trivial, we will obviously ignore that discrepancy. But if it's more than clearly trivial, we'll be asking a question and trying to find out why that difference exists. Okay, so where were we? Risk management. Let's move on to crypto compliance breaches. So some of the things we've just spoken about just now, it's when trustees invest in Bitcoin and to trade and not just hold the asset, there's a lot of risks involved there. And one of them is it a related party transaction? Has a contribution been made by crypto, and can that be accepted? And we've just quickly gone through that. We'll be going through that in more detail. Has the fund lent money or provided financial assistance to a member or a relative, or has the fund simply borrowed money at the end of the day? And what about where there's a charge given over the assets of the fund? Let's quickly just go through these and to see what the compliance issues are. So in accordance with Reg 409A, all assets have to be kept separate from money and assets held by the trustee personally. So the fund's going to comply with that exchange account, the wallet are held in the name of the fund trustee as trustee for the fund. So we do have difficulties where the wallet is held with the exchange and it's in the member's personal name, and we need to find out whether that's been held custodially or it's actually just held in the member's personal name because that account was set up incorrectly. So we need to ask more questions. And the other thing to consider here too, that is all of the transactions that the fund is using to buy cryptocurrency with must be undertaken from the fund's bank account to ensure complying status at the end of the day.
Shelley, are you still there? So I think we've got a, I think Shelley's frozen. So just give us a moment and we'll try and get Shelley back. Shelley, you disappear. You're on mute. You're on mute, Shelley.
I'm sorry about that, everybody. I don't know what happened. Just let me quickly reshare my screen. The wonders of technology. So we'll just put it down to that. Sorry. So under section 66, the fund can't accept crypto via a contribution from the member or from a related party transfer, because it's going to breach those acquisition of assets rules. And we're going to be checking bank accounts to make sure that all those crypto purchases are being paid for within that fund's bank account as well. Charge over assets of the fund. Well, this can obviously happen when the crypto exchange is going to allow the user to either hedge their crypto against a standard currency or other cryptos. Now, where we see this happening traditionally in derivatives, we can accept a separate derivative risk statement under Reg 1315 because the charge is given out. Now, that is exemptions only apply to those transactions being undertaken by approved bodies, such as domestic and foreign exchanges and other clearinghouses, which is listed in Schedule 4 of SIS. And guess what? That list doesn't include cryptocurrency exchanges. So if a fund trades in derivative products using Bitcoin, the fund's going to be in breach of Reg 1314. And the reason for that is that the charge is being given over fund assets, which is basically the wallet, to undertake those hedging activities or make margin deposits to the exchange to counteract that, eliminate that counterparty risk. And one of the things here to consider is that some crypto exchanges are quickly developing these sophisticated, unregulated financial instruments, which is going to end in compliance breaches for funds and headaches if they take them up. So be very careful about what you're investing in from that point of view. Crypto trends, well, there's a lot of language about, excuse me, crypto, and I'm not fluent. I only know what I need to know. And the concepts that we do need to have an understanding of is really what our clients are investing in. And we need to look at it very closely and identify whether there's any breaches of SIS that we've already just gone through. I'm only going to be looking at 3 today, but there's going to be many more out there, and there'll obviously be many more developed in the not too distant future. So the first one is staking, where the fund effectively lends its crypto to an exchange for earnings of more crypto. And that's like a short-term loan to an unrelated party, which in and of itself can be okay. But the problem is that the lack of documentation. So the reason is that the client is clicking on a button on the exchange website to enter into the staking program, and there's no information coming through from them apart from what's on the website, which then quickly disappears once they click on it. So it's very interesting that we have this very sophisticated technology where we can look and verify transactions and look at the public ledger, but the reports in a lot of respects aren't sophisticated at all, or in some cases they're non-existent. So all we can see here is the crypto going into the exchange, and then we see additional crypto coming back in without any type of information or documentation surrounding that. Airdrops can also be similar in terms of a lack of documentation, because an airdrop is just a marketing stunt by a company that involves sending out coins and tokens to wallet addresses to promote awareness of this new currency. So the amounts can be very small, and some of the airdrops can be sent for free or also in return for small services such as retweeting a post sent by the company issuing the currency, for example. But if the trustee kept the airdrops personally, that would obviously be a breach of SIS. And the last one I want to quickly cover here is crypto loans, which we're seeing coming up a little bit more of. And this is where providers are giving same-day loans to fiat currency to trustees once they've transferred an amount of crypto to their loan provider's storage address. So the terms here can be flexible. The trustees can make monthly repayments or not at all. And at the end of the term, the loan is finalised and the crypto gets returned. So needless to say, this arrangement is a hard no from a SIS point of view. It's a breach of fund assets being used as a security for a loan, which is a breach of Reg 1314. It's exactly the same as if the trustee gave the bank the fund's property as security for a loan, and that will also result in the same breach. And obviously these products should be absolutely kept away from trustees at all times. Death of the Bitcoin wallet, one of the biggest headaches that we're going to see, and we are seeing in some cases, where the active SMSF trustee loses the passcode to access the wallet. So you've got the private key and the password to access the wallet, which is known and set up usually by the user. So there may be other trustees who aren't aware of it. And it may not even be death, which is the issue at the end of the day, because in January this year, there was a guy in San Francisco who had 2 guesses left to figure out a password to his laptop that gave him access to his private key for a digital wallet, which held over 7,000 Bitcoin, which is just over $300 million at today's rate that he does not have access to. And in fact, in that article, it said that Chain Analysis, which is a crypto data firm, believes that around 20% of all Bitcoin is either lost or just stuck in stranded wallets. So as much as we hate banks, at least you can get your money back if you lose your PIN at the end of the day. So here we're seeing documentation and making sure that this information is shared between the trustees is critical, because otherwise, you can lose your crypto forever very, very quickly and very easily. And it's really difficult to think of another asset unless it's actually in a tax haven that can't be recoverable when the trustee dies. So we really need to look at this as being Bitcoin insurance. And where that Bitcoin is a material asset in the fund should be documenting the fact that precautions have been put in place to securely pass on the details to other trustees or beneficiaries. Okay, I'm going to just, in the time we have left, I'm just going to quickly go through a couple of slides. Auditors obviously gain access to third-party crypto transactions and pricing through websites such as Block Explorer. SMSFs provide us with a list of transactions on an Excel spreadsheet from their wallet, which contains the public key, and we enter that public key from a spreadsheet into a website that provides us with that ledger, and we can see what's happening. We also need to have other records available made during the audit, such as receipts of crypto purchases or transfers, exchange records, and also digital wallet records and public keys. So I guess a fairly generic crypto checklist is a trust deed. Is there a prudent trustee investment clause? Do the governing rules allow crypto investment? What about the investment strategy? Does it discuss all the definitional elements of Reg 409, in terms of crypto? What about the wallet? Is that in the name of the fund trustee as trustee for the fund? Have we got a screenshot of the accounts? Valuation, let's have a look at the prices on June 30 through a reputable trading platform. Check the prices after year end also to make sure that there's no post-balance date event that needs to be noted in the accounts as well. CGT on sales, we want to see the sales between the crypto with the prices converted back to Aussie dollars, because it's typically in US dollars, and the proceeds, we need to see those in the fund's bank account. Transactions as well, we'll also be reconciling opening and closing unit balance to statements. We're looking at what the transaction was for and who the other party was, even if it was just their crypto address. And we want to make sure that all of these are on an arm's length basis. So we're going to ensure, for example, by inquiring that there's no commissions or fee rebates that are being paid to or directed to the members personally. And just remember too that when a member does satisfy a condition of release, the fund can make an in specie lump sum payment by way of transfer of cryptocurrency, but all the pension payments have to be made in cash, not in crypto. Okay, some trust deeds do have specific clauses that reference cryptocurrency and go into a lot of details. As I've said before, usually we just see that get out of jail free clause. With the investment strategy, the types of things we're looking at is it allowed in the investment strategy? Does it look at risk and volatility? Is that documented? If the fund's also using ranges in the investment strategy, we need to check that the investment is within the ranges for the cryptocurrency. And if it doesn't, we need to ensure that the decision to invest is documented in there as well. We also want to make sure that if it's material, that those other issues such as diversification and liquidity is also covered off as in the investment strategy in relation to cryptocurrency as well. All right, a trustee minute. We may also require a trustee minute if the investment strategy falls a little bit short in some of these areas, which will just act as an addendum to the investment strategy. And it can also contain information such as risk and volatility, which may not be documented within the investment strategy. And it can also just state that the trustees are obviously aware of those issues. And the reason for that is that we're obviously required to have sufficient appropriate evidence on file, which ensures that the trustees have given effect to their investment strategy, and once again addresses all those additional elements of Reg 409 in the proper format. So obviously we need to cite and save evidence to confirm the fund's holding in crypto, and that's market value in Aussie dollars. We're going to confirm the purchases and the income, and also look at the expenses where necessary. So let's have a look very quickly at a holding evidence matrix which I've developed, which might be of benefit to you. And what we're going to do, if you'd like a copy of this and all the other information we're looking at, ASF Audits has actually put out a crypto fact sheet, which can be found at our website, www.asfaudits.com.au. When you get to the homepage, simply put your mouse over the blog menu, and in the drop-down section, you'll see download loadable resources option. Click on that, and then that will give you free access to our fact sheet, which is going to contain a list of all the regulatory considerations on crypto, and also this matrix and other things that we require at audit. Now, just remember, while this is our requirements at audit, your auditor may have other requirements as well. We've just put this together and released it so that, you know, it provides a little bit more certainty around an area which has a lot of uncertainty and a lot of unanswered questions at the moment. But back to the matrix, each column here refers to what we're looking at in terms of the exchange and what we need from the wallet. And it doesn't matter whether it's a cold wallet or a hot wallet, we're going to be looking at what's needed in both of those. So we need to have verification for each account, and we need to have a look at a full year transaction history. That will be something which will be non-negotiable. We'll need that in every single case, as opposed to a holding statement or a signed declaration if that full year transaction history isn't available, such as if there's no transactions. We need to have a look at the wallet address ID, and we also want to have a full year transaction history, a snapshot from that wallet, and we also want a signed declaration which will confirm that the wallet is used and owned wholly and exclusively by the fund. With the signed declaration contents, we're only going to need this from the exchange if the holding statement's not provided. And then we'll be looking at what types of crypto is being held, what's the market value, what exchange it's held at, and what confirmation holding is held by the fund. And similarly too, for a cold wallet, we'll need the confirmation at June 30 via an exchange explorer for each crypto, confirmation and quantity of value, and also we want to make sure that that evidence is secure and make sure that that insurance effectively is in place as well. Lastly, we want to have a look at the market value in Aussie dollars, because we can't rely on the holding statements. As we've said, they're unaudited reports. So we're going to use a crypto website such as CoinGecko, Yahoo, or coinmarketcap.com to be able to convert that over, if it's in US, over into Aussie dollars, and make sure that it's correctly stated and fairly stated on the balance sheet. Okay, what happens if there's variations in value? We've already been through this, but it's very simple and easy. If it's above clearly trivial, we're going to request further details. And if the holding statement calculations are above clearly trivial, we're going to raise a query at the end of the day. Let's move on. How do we confirming buys and sells? Well, first off, we need to identify what transaction it is. Have they bought crypto with cash? Has the fund exchanged crypto? Have they traded in their Ethereum for Bitcoin? And have these transactions been done either on or off an exchange? So similar to the holding verification matrix, this is a confirmation buys and sells matrix, which will hopefully make things a bit easier. And once again, we have their confirmation, the criteria for the exchange and for the wallet. So where the crypto has been bought or sold via fiat currency, such as Aussie dollars, this is what we need at audit. We need to see the transaction listing for the full year, because once again, we'll verify those transactions using the wallet address ID through an Exchange Explorer website and reconcile back to the bank account. The wallet is also a similar story. We'll confirm the receipt amount to the bank statement, get the transaction ID, and enter it into the Exchange Explorer to confirm what's in the wallet. And where that crypto has been exchanged for other crypto, we're going to do the same, but just confirm that the crypto has been sent or received instead of cash for both the wallet and the exchange. We don't need a signed declaration for the exchange, but we do want to get one for the wallet, which states that the crypto wasn't purchased from a related party, and that's going to be requested as being part of completing the audit. One of the other issues that we see in terms of Bitcoin and trying to reconcile back to what's in the financial statements is that we do have missing Bitcoin that doesn't reconcile to what we've been given in terms of the wallet. And what that means to us is that there's other wallets out there which we haven't been given information about at audit. So where we do have missing Bitcoin that we haven't been able to reconcile, we're going to ask you for the information in relation to those other wallets and all of the information that are in these matrices to provide us with the audit evidence that we require. Income and expenses are pretty easy and straightforward. There's no income from crypto because it's for CGT purposes, but where you've got staking rewards, for example, they're considered to be ordinary income, and you'll need to include the Aussie dollar value of those rewards in the fund's assessable income. Now, the cost base of your staking rewards is their market value at the time you receive them, which is the same amount you put in your assessable income. So if the fund received a staking reward on 15th of March 2021, the market value of $5, you'd include the $5 in your assessable income, and the cost base of the staking reward would be $5. But we'll still need to review for expenses, which could include the cost of the wallet, for example. So obviously we'll be requesting the supporting docs for those expenses and also making sure those invoices are in the correct name of the fund. So lastly, how are we going to report on crypto in the audit report and the management letter, and what can you expect to see and why? Well, where crypto is a material asset on the balance sheet, we're going to qualify Part A of the audit report because we won't have been able to determine, as we've said before, where there are material misstatements in the financial statements in relation to this investment. And the reason for that, we cannot rely on the reports provided by the exchange or from the wallet. They're not audited. So please don't be surprised if you see a Part A qualification if there's crypto in the fund from your auditor. And yes, this will need to be reported in the annual return under question 6, section B. But as the qualification is a result of the requirements under the auditing standards and not necessarily related to a compliance breach of Reg 8.02B, for example, the ATO would most likely conclude that it's a low risk breach and not undertake any compliance action. So you can see in the basis for this particular qualified opinion that it states that we've not been able to confirm sufficient appropriate audit evidence for crypto, so we're unable to determine whether there is that material misstatement or not. And the types of issues that come into play here include the inability to determine that the reports haven't been fabricated with a fake wallet ID, and that, as we've said before, the fund's crypto has been lost. So while we can do everything we can to verify what's in the reports, we can't actually make that final link because we have no way of identifying the fund actually holds the crypto apart from the information that comes to from us in these reports, which, as we said, are generated from unaudited platforms. But obviously the more regulation we're going to see into the crypto industry, it's going to see a tightening of these requirements to trade in crypto, and these platforms may meet the requirements to obtain an ASAE 3402 report. Just lastly, Daniel, you'll see potentially a management letter comment which may be in the relation to security of fund assets, which we know is mission critical when it comes to crypto and wallets. So I'll hand back over to you. I know that I rushed through that last bit, and I'm sorry we lost the connection for a little bit, but yeah, hopefully we've got any questions in the time we've got left. We'll see how we go.
Yeah, look, we've got a couple of minutes left, and there's a few questions on here, so I'll just work through these quickly, Shelley. Client transferred money to one cryptocurrency wallet, which is the wallet has been shut down. They've registered the ACSC report cyber. Is this good enough for audit purposes for the stolen money?
It depends. That's the name of my book, right? It just depends, because is it material? So if it's material and we're looking at typically crypto that might be worth 5% of fund assets or $30,000, whichever is the lesser, and depending what information and evidence you're providing us with, it may well be that it does have to be reported in an ACR, because we have simply no evidence that the wallet has ever existed. Does it exist? How has it been closed down? Why has it been closed down? There's not enough information in this particular situation to try and provide a specific answer. The answer is it depends. So you would find the auditor would continue to ask questions until they were either satisfied or couldn't satisfy whether or not that wallet did exist. And you would find that the nature of the audit report, the ACR, would be not that there's necessarily a breach, but we do not have sufficient appropriate audit evidence to confirm the existence of the wallet that has been lost. It would be unusual that you've transacted in crypto, you've moved it across to a wallet, and then somehow the wallet's been closed down with simply no evidence whatsoever available at audit. So we need to have a look at the facts and circumstances surrounding that to be able to provide a more definitive answer.
Thank you. Look, there's a couple more here. I hope we can get through these quickly. But Jamie sent a question saying, moving forward, can I earn equity issues with this on my crypto if on an exchange but never sell? What implications on money earned equity from the crypto, etc.?
So what do they mean by, what do they
yeah, I'm not sure they're saying, moving forward, can I earn equity issues with this on my crypto if on an exchange but never sell?
Is he talking about potentially just moving from one staking sort of situation to another? Like,
I'm not sure. I might get Jamie to reach out.
Yeah, please do. Happy to take that question from Jamie direct.
I have a BlockFi account and I earn interest on the crypto on this platform. Unfortunately, the account cannot be in the fund's name. BlockFi issue all relevant statements. The money is only the super funds, but it shows the personal member's name. What audit evidence can I provide to show that this is okay? Can I just do a declaration of trust to confirm that this is the fund's portfolio? Well,
that will depend up to your auditor. I mean, if we can see that the money's come out of the super fund, in this day and age, most of the exchanges are allowing super funds to
we just lost you again, Shelley.
To own the. Oh, bloody hell.
Yeah, you've cut out again.
I've cut out. Okay, I'm sorry. I look like I'm here, so I don't know why I cut out. Am I here?
Now. It's good now.
It's good now because I didn't miss a beat here, so I am very sorry. I haven't had problems with the internet all week, so I do apologise. Sorry, the question was in relation to. I just threw myself. What was it? What was the question about, Daniel?
The BlockFi account and having to do a declaration of trust to confirm.
Oh, that's right. Yeah, it will depend on the auditor and trying to understand what exchange you're using, because most of them will allow you to, or the big ones at least, will allow you to have that in the name of super fund. So it'd be interesting to see what exactly you're trading on, what exchange you're trading on, and why you're selecting that, and why you're selecting one that can't actually provide you with an account in the name of the super fund. So we probably need some more information there as well.
Two more. Lena has asked, what is the reputable Bitcoin website for pricing at 30 June?
Well, I think we've put in ours back here. We're using CoinGecko or Yahoo, or you can use coinmarketcap.com.
Nice. Last one from Chris Kiddo. Will ASF issue a Part A qualification for all SMSFs that hold crypto?
Generally, yes, simply because the risk that we're taking in terms of signing off on these particular funds with crypto in it is significant. There's a lot we can't guarantee. I mean, I know that everything's on the blockchain, everything's traceable back to a wallet ID, but at the end of the day, there can be fraudulent transactions that have been undertaken very easily. There may be a lot of research taken from the internet, which can, help generate reports that we have no way of knowing are real or not. And let's be honest, some of these reports don't look very sophisticated either. It looks like it could be done by a 12-year-old with a PDF maker. So we need to actually make sure from a risk point of view that we're not only that we're looking after the interests of the trustees, but also too, we're meeting our professional obligations, not only under the compliance SIS legislation, but also under the auditing standards. Yeah. And we would be potentially required to do that for each and every transaction.
One last one, and this will be it. So when opening a Bitcoin account, I found that many Bitcoin exchanges don't allow for an account opening directly under SMSF, but rather under the entities such as individuals, trusts, or companies. What is your opinion on this? Can the account be opened up under the trustee company to comply with this purpose? I think you answered that before.
That's a slightly different situation too. I think that you're talking about if there's a corporate trustee, can it just be opened in the name of the corporate trustee only? And the answer to that is, if it's a sole purpose corporate trustee, the answer is yes. And we would obviously need to see a copy of the constitution to make sure that it is a sole purpose corporate trustee. Alternatively, if it's not a sole purpose corporate trustee and it's used for other entities, there's really at the end of the day no guarantee that that money is going to find its way back into the super fund in the event of death of one of the members. So we need to be very careful at the evidence that we're looking at in terms of that and understand why that's the case. And it may well be that it may well be a qualification at the end of the day. It's very difficult to give a black and white answer to a question that has so many different sides to it.
And Chris Kiddo has left a comment, awesome, I'll bump up my fees. I'm sure you know Chris quite well.
I know Chris well. No.
Look, Shelley, thank you so much for such an insightful presentation. You're amazing, and your level of knowledge is fantastic, and you've added so much value and great content to everybody that's joined us today. And we will make the slides available, but as Shelley said, they are subject to copyright, so personal use will be okay.
Yeah.
On behalf of BGL, just thanks, Shelley, and thank you to everybody that joined us today. And I'm sure that you've all walked away with a little bit more knowledge and confidence in dealing with these types of transactions or financial instruments, which is really important. So thank you so much. We appreciate you, Shelley. Thank you.
Thanks, Daniel. And thanks, everyone. Good afternoon. Have a great day.
Thank you. Bye-bye.